Greetings, Jonathan Camarda, Chief Investment Officer. Hopefully the guys are all doing well. So let's wrap this January up. It's actually been a good January. So let's see what that has meant historically, and then we'll look through the windshield of what we're seeing going forward. So when you look historically on years for the S&P 500 over the last 72 years, when you've had a positive January like we've had, only 7 of the years the index actually finished with a negative number. So that looks pretty good on a ratio, from a ratio standpoint, on the NASDAQ 100, okay? That was down 33% last year. Again, the triple Qs there. Just to give you a little perspective on the climate would have to make to get to even from last year's losses, you'd have to make 50% on the math to make up the 33% loss last year. So just to give you a heads up, with the rip we've had in the NASDAQ recently, it's only made up a quarter. That's 25% of its losses last year for perspective. So now as we look at what history's brought us, let's look forward to what we're seeing as well. Now we're going to start on the commodity side out of India, not so sweet note, where some supply issues with sugar, very reminiscent of the 70s as well, as this decade continues to try to track its 40-plus-year-old cousin there from the 70s. Again, a shortage of supply could cause a trickle-down effect for Europe and the U.S. With increased prices, which again would cause commodity prices to go up as well. And inflation in general, as we're looking at, again, pretty persistent and stubborn, as we've talked about. If you look at the tight job numbers, again, that's what the Fed's looking at, even if they're just on the surface, right? Because we've seen certainly a lot of layoffs and weakness when you look at the large tech companies and now the financial behemoths as well. But that's more of a leading indicator. And trust me, the Fed will be looking more at the surface level tight numbers and making their decisions. Wink and a nod. Also, rent prices are still pretty high, to say the least. And all this points to the Fed continuing to keep their foot on the gas pedal. And that soft landing that these cute little pundits on CNBC, Bloomberg, Fox Business, and all of that, they keep talking about that soft landing, Mayday, probably more wishful thinking. Given the monetary tightening that we've had, it's been multi-decade as far as its stringentness. Again, very unlikely we have a soft landing. Now, when we look at what the companies have actually been doing, look at the earnings. Earnings have actually come across pretty decently, but when you look under the layer there of even the top tech companies, the large ones that are doing quite well this month, the earnings haven't necessarily been great when you just look by the data. Now, sometimes you have to look beyond what they report data-wise, right, and then go into the actual conference call with the CEO. And with their generally, again, the biggest, components to look for on what they're projecting ahead when they look at revenue are labor costs, right? They're looking at input costs, interest rate costs, and as such, real estate, a lot of different metrics there. So very interesting. And although you look at December, only four industries actually had profitable December profit margins, and that would be energy, of course, real estate, industrials, and utilities. So now, as we look forward, what are we looking at? Well, with the Fed, everyone's looking at, essentially 25 basis points. That seems to be the higher percentage play. However, again, 50 basis points is not off the table. With some of the aforementioned stickiness, we're talking about an inflation, and of course the market doing well, which you say, well, that's generally not a mandate of the Fed, right? Well, the playbook has basically been stitched and re-engineered because when you start to hear these same pundits talk about, well, positive month of January for the market, the Fed needs to react to that, and they probably will. Of course, you've never seen this before, but don't rule it out because the Fed, which is playing so far behind the game from the transitory post-COVID days, needs to keep running, even if they run through the proverbial outfield wall to catch that ball, which again, they won't. In other words, it won't be a soft landing, but they'll still run through the wall because optics-wise, it makes sense. And, not just optics, but we have persistent inflation. Now, recession, of course, which has been here since last year, we called it, is still obviously there as well. We talked about the aforementioned layoffs, regardless of the tight labor market. The numbers of essentially people being let go by all of your large tech companies and across some of your financial behemoths as well is, again, what we talked about, a leading indicator of recession. Now, we've also seen the yield curve become even more inverted. It is more inverted than it has been over the last 40 plus years. Again, inverted meaning that short-term rates are higher than long-term rates, which belies the usual logic of investing, right? The longer you're willing to risk your money in fixed income, the higher the rate you get, that is flipped on its head, which means that's a negative future consensus of growth. So again, you have, that strong inverted yield curve, gold, which has been firming up. And now the dollar and interest rates, as we've seen, have come crashing down from last year. And of course, they basically held the market for hostage. And that's why you've seen the market pop up. Like we talked about, these correlations, they all kind of move in tandem, much like a marionette, right? Dollar and interest rates go down, and we've seen a respite for equities. And of course, your large caps as well. Why? Well, with a weaker dollar, they can sell more of their goods, easy for me to say, overseas, right? It's all connected, much like our bodies, right? Much like our nervous system. And the market's the same way. So when you have a sensory here, it affects a sensory there. And sometimes we're not always thinking in those pairs, correlations, but those actually have an effect. So with all that being said, technically, because I know you love your charts, wasn't going to forget them on you, the market's been ripping to the upside. However, again, maybe a yield sign in order because the market's coming up against strong resistance across all the indices. Two stronger ones recently have been, of course, your Russell 2000 small caps, the aforementioned NASDAQ 100, and then the Dow Jones has been the most resilient over the last few months, all coming against major test points. During a week in which the economic data and Jerry and the Feds, cue the band, are getting ready to play as well. Will it be 25 or 50? Okay, I was going to reference a Sammy Hagar line, but the numbers didn't match up. So with that being said, you probably had enough of me, and by the time you've seen this, you've already enjoyed your NFL weekend. So until next time, when we can actually summarize the autopsy of what the Fed has done, until then, stay frosty. Jonathan Camarda.